Good morning. Welcome to the How to Set the Right Price and Why It Matters webinar. This is part 2 of the webinar. Part 1 is available for replay. You'll get a link to that in an email, as well as a link to this webinar in an email after the webinar is over. Today, we're going to talk about the principles of pricing and burden and labor rates done right now and forever. We'll get started in just a minute or two. While you're waiting, you might want to go to the link here. It's also in your chat box, and get the exclusive Excel labor rate and burden templates. You may want to walk through those with me when I am going through them during the webinar. We'll get started in just a moment.
Good morning, everybody. This is Kevin Kehoe, and I'm here with Greg Herring today. This is part 2 of our pricing seminar. A couple things before we get started. There is questions, so if you have Q&A, you'll notice there's a Q&A button. You'll use that to create your questions, send those to us. Secondly, there is a chat function. Greg will explain that as we go, but Greg will ask some questions and request or require responses from you guys. So if you use the chat function, that's what that's for. Greg is a great partner with Aspire. Aspire, we've been around about 6 years now as a fully integrated cloud-based software system built for contractors for construction, snow, and maintenance. And so inherent in that software, right, is the way you price. So doing that fundamentally correctly, right, and then turning that into a series of best practices, right, is something you do with software, whether you do it on a spreadsheet or in a system like ours. So Greg, I think I'd turn it over to you to get it started, talk to your piece, and then at the end we'll finish up and chat a little bit about where we might go from here with some benchmarking ideas that we have. So Greg.
Thank you, Kevin. I'm excited to be here with everyone today. Before we get going, let me just make sure that you have your microphone muted and that you find the chat box. So I want to get started just getting everyone used to that chat box. So when you think about 2020, are you optimistic, unsure, or pessimistic about your business in 2020? So just go ahead and type in your answer. We've got one optimistic, and let's just keep another optimistic. Good. Another optimistic with an exclamation mark. Awesome. Jack's optimistic. Matt's optimistic. Susan's optimistic. Very good. Michael, Forrest, Nate, Jessica, all optimistic. All right. Anyone else? We got an optimistic in all caps. Yeah, Shannon.
So maybe no recession, Greg.
Maybe no recession. All right. Now it's easy for us to get lost in the minutia of pricing, and we're gonna get down into some minutia here. We're also going to do some high-level discussions. So don't get scared away. But I want to frame this in the context of opportunity, right? So the benchmark reporting that I've done has suggested that the average landscape company makes 4.6% net income as a percentage of revenue. So $10 million company's got $460,000 on the bottom line. Kevin and I are passionate about seeing that change. That's what drove him to be one of the founders of Aspire, and it's what drives me in my business. We want landscape companies to make between 10 and 12% on the bottom line. That's after depreciation, after owner's compensation, after every expense. We want to see 10 to 12% there. And so sometimes it's easy to get lost in the percentages, so I want to frame that in dollars. So if you look on the left-hand side there, your current profitability. If you're at 4.6%, then just pick 4 or 5%, right? If you're at the average, if you're at 7%, pick 7. And then across the top, I want you to find your annual revenue. So the revenue for the last 12 months. And then I want you to take the intersection between those two. So in this example, you'll see that 320,000 is the intersection between 8 million and 6%. This says that $8 million company's got $480,000 on the bottom line. and we think should have at least 800,000 on the bottom line. That's a $320,000 opportunity. But that's not all. Man, I sound like a salesman saying that. That's not all. Most of business owners are going to sell their business one day, and landscape companies these days are going for about 6 times earnings. So you're going to put $320,000 more on the bottom line. That translates into 1.9 million of additional cash on exit. So you get $320,000 every year, and then you get a bonus of 1.9 million when you sell. That's important. That's important. That's a big opportunity, and we believe that owners ought to be rewarded for the risks that they take in starting a business, maintaining a business. We also think that that level of profitability is important for long-term sustainability, to ride the ups and downs of the economic cycle. All right, I want to just cover one topic from last week that occurred to me after the webinar, and that's this danger of pricing to gross margin. Danger of pricing to gross margin. And I don't think that's an overstatement to call it a danger. I hear branch managers, I hear some owners, I hear account managers saying, you know, in our market, we have to be at 44 points of margin on maintenance. Okay, I'm pulling that number somewhat out of the air. So don't go right down that Greg says that 44 points is the right margin, right? But someone will say that to me, and I'll just kind of think, depending on the situation, I might ask them, where'd you get that number? Well, it's just what it's always been in this market. Well, the problem with that is most people have spent time in different landscape companies. And if one landscape company is at a 44-point margin, that doesn't mean that every landscape company is at the same margin. I want to demonstrate that in this slide here. So we have a couple of clients at the Herring Group that have no labor burden above the line, above the gross profit line. So in this case, revenue is $3,700. The direct labor wage cost of the people assigned to the job are $1,500. They have no normal labor burden. That'd be like payroll taxes, workers' comp, overtime premium, kind of a normal labor burden. They have it at zero above the line, above the gross profit line in their direct costs, zero. Some people put indirect labor, so crew time, maybe it's shop time, startup time that is incurred by the field labor, the direct labor, and they put that up in above the line. That indirect time, they put that cost, they put that above the line, and I have that represented at 18.7%. These are made up numbers. And so this zero burden option company is going to show a gross profit margin of $2,200, 59.5% gross profit margin. So you might have an account manager come into your company if you're in this situation and say, 59-point margins, we can't sell for that. We've got to be at 44 points. Well, if you look at that labor burden, right, 545 is the sum of those two percentages multiplied by the $1,500. The adjusted gross profit or adjusted gross margin, that's kind of a made-up term by me, is 44.7%. That's that 44 that we were referencing. So another company might include the normal labor burden and might exclude the indirect labor. That's kind of a normal case that I see. And in that case, the price is the same, $3,700. The labor cost is the same. Above the line, they have this additional $265 of expense. So their gross margin now has dropped from 59 to 52, right? 7-point difference in that gross margin. So, but the bottom, you know, the total cost is the same, or the total profit on this job is the same at $1,655, 44.7% margin. The last one is they include everything, right? So everything's above the line. So the 265's above the line, 281's above the line, and their gross margin is 44.7%. So you have an almost 15-point swing between the zero burden option and the 44.7 in including everything in labor burden. So what margin is the market? The price is the same. What margin is the market? Well, the answer is it depends on how companies account for labor burden, right? That dictates margin. So my encouragement to you is if you have this issue in your company where they're talking about what the market margin is, that you really clarify where they're coming up with that number, right? And I just think it's a dangerous discussion to have. All right, so I'm gonna that's a little bit of review from last week, but I want you to know that the last week's, if you missed it, is available as for a replay, and you'll get a link to that. Let me tell you a little bit about my story because it really provides a little bit more context for why I care so much about this topic of pricing and profitability. So these kids are in a village in the Eastern Congo, Democratic Republic of the Congo. It's one of the richest countries in the world in terms of natural resources and one of the poorest countries in the world in terms of how people live. And you can see that in this picture. There's one pair of shoes in this picture. The clothes are very tattered. The bellies are very large. That's from hunger. And the girls in this picture, they're going to grow up more than likely, and they're going to work in the fields growing crops. And they're going to grow crops using a hoe. When I saw this, I started thinking, why are they using hoes? So I did a little research on Google. We were using plows pulled by animals in the late 1700s. We're 200 years later, and these people are using hoes. Why is that? It's because there are no businesses that offer anything else for them to use. It's because there are no entrepreneurs creating businesses for these people to buy stuff from. And so they get hoes because they're given hoes by non-governmental organizations because that's what everyone needs and wants. They don't have plows. They don't have tractors. They use hoes. So when I look at the poverty here and in this country, I looked at it and said, there is an absence of business formation. There's an absence of entrepreneurial activity. And so I go over there and been going over there for 11 years now to help teach innovation and entrepreneurism and business formation. But what it really did for me was when I came back home, it made me grateful for all the entrepreneurs that we have in this country and the risk that they take, the uncertainties that they embrace, the jobs that they create, the opportunities for people to buy things, goods and services in their community that they create. And I got passionate about making sure that those entrepreneurs were adequately rewarded for their risk, not so that they could get rich, but so that their businesses would endure and would grow and be sustainable over the long term. And that really is what drove me to do what I'm doing today. All right, that's a little context. I always take people with me. This is a commercial. I always take people with me over there. If you'd ever like to go with me on a trip over there, your life will be changed. You'll love it. And just email me. All right, today's agenda. We're going to talk about 3 pricing principles. This is going to be something you didn't expect. And I like to start at high-level principles and then let people apply those principles in terms of practices in their local markets, in terms of what works there. But we're going to talk about these principles. I think you get a lot of value that you weren't expecting out of this. And I hope that it will spawn some thinking after the webinar. We're going to talk about how to recognize a labor cost alignment problem. This is very important for those of you on Aspire. Aspire makes it easy for you to recognize when you have a labor cost alignment problem. And we're defining alignment as we want your estimates that you do for proposals to reflect your actuals, right? And if your estimated burden rate, doesn't reflect your actual burden rate, your proposals are going to be mispriced. Could be too high, could be too low. And I'm going to show you exactly how to recognize that. It's an easy thing to do, and I recommend that people look at that every month. We're going to actually go through calculating labor rate and calculating a labor burden. Kevin's going to explain a second method for overhead recovery that may appeal to some of you. We covered overhead recovery on the last call, and Kevin's going to talk about that. And then I've got, at the very end, I've got 6 warnings for pricing changes. So it's not as simple as just making the changes, right? There or doing the calculations and inputting them in Aspire. There's some warnings that we have that we've learned over time as we've helped companies do this. And we want to share those warnings with you, just things to remember. We'll get to that at the end. You won't want to miss that. All right, so let's talk about pricing principles. The first way to price is to price to cost. I think retailers do this, right? Retailers know what margins they need in order to cover their overhead, so they price to cost. What do you think landscapers do? Think landscapers price to cost? Why don't you just chat in your chat box there, yes or no, landscapers price to cost? All right, just use your chat box and type in yes or no if you think landscapers price to cost. Shannon says yes. Susan says no. Jack says sometimes. I like that. Bradley says yes. And Nate says, I like this one, not if they want to stay in business. Right. I've got some no's, 3 no's, a yes, sometimes 3 more no's. I have to say I disagree with the no's. I think landscapers price to cost, and I agree with, I think it was Nate that said, not if they want to stay in business. And one of the things we encourage our clients to do is to think about alternative ways to price. And that's what we're going to talk about today. I'm going to use some examples in the marketplace outside of landscape industry to get your juices flowing, get your brains firing. And then I want you, after the webinar, maybe to discuss with your teams how you can apply these principles in with your services in your market. I had one landscaper tell me, this landscape business owner, Greg, when it comes down to it, fundamentally, the landscape industry is selling hours. It's selling hours. And I'm like, well, what about your experience? What about your knowledge of plants, plant healthcare, construction? Are you selling that? So that was my first clue that we really needed to have a discussion about these pricing principles. So another way to price is to price to market. This is how commodities are typically priced, right? What's the oil price, a barrel of oil today? What's gold selling for today? What's silver selling for? That's price to market. Stocks are priced to market. The last way is price to value, and that's really where we want to focus. And that's where we focus on the pricing to the value that we're providing to the client. And one of the things we'll talk about at the end of this exercise we're about to go through is we'll define cost, probably in a way that you wouldn't expect. All right, so I'm going to start with, what do you sell? What do you sell? So one guy sells hours, right? All right, what do you sell? So think about that. That's a very simple question, but the answers can be quite profound in helping you think about your company and your business strategy. So Nate says, we sell an experience. That's really good, really good. All right, so what is this? What are they selling? They're selling something to stay cold, right? Can you see the brand on here? Anyone see the brand? It's very hard to see. You can just make it out down here in this corner. This is a big brand when I was growing up, Igloo. They were the dominant in terms of coolers. And so they're selling cold drinks, and that's what they're selling. And so when you want cold drinks, you can buy a 120 quart Polar cooler for $59 on Walmart.com. 59 bucks. I don't even know. And that's with free 2-day shipping. I don't know who's making money on that, but it's not Igloo, I would suspect. What's the brand here? What are they selling? This is actually a brand out of Austin. Very proud of that. I'm in Austin. And so this is a great homegrown success story. Yeti. Some of you may have their ice chests. Some may have their coffee mugs, right? So we see the Yeti brand very prominent as opposed to the Igloo brand. And let's see what they're selling. Now, I'm not picking on anyone, by the way, who has a Yeti. I have Yetis, and I'm not picking on us, right? I'm just pointing out something that I want to inform how you think about that question, how you sell, because that will impact how you price. All right, Yeti ice chest, built for the wild, wildly stronger, keep ice longer. I like the next one there. It proves it, right? The last ice best, little typo there, you'll ever need. This is a real ad on Google. Shop now, grizzly proof. Man, I need grizzly proof. There are a lot of grizzlies in Austin. I need that grizzly proof cooler. Fast shipping, 5-year warranty, Rambler drinkware, maximum ice retention, premium coolers. Perfect for any pursuit. Keep ice for days. I need to keep ice for days really often. How about you? All right, so what are they selling here? Just respond in your chat box here. What are they selling? Lifestyle, Jared says. I like that. Mark says image. Shannon, lifestyle, brand, durability. Matt says experience. I think Matt's onto something. Matt, what kind of experience are they selling? They selling like a going to the opera experience? What are they selling? Lisa says brand. Michael says better mousetrap. LOL. Perceived experience. Rugged adventure. Lisa says. John says outdoor experience. That's right. They're selling adventure, and I think really what they're selling is they're selling the aspiration of adventure. You know, not many people need a grizzly-proof ice chest, but more people that need it probably would like to need it. They dream of one day going off and being in the woods for 5 days with grizzly bears and needing to keep ice cold for that long. But they probably, not everyone that buys one needs that, right? So they're appealing to aspiration there. Powerful emotion, right? Powerful emotion. You take emotion, one thing that landscapers could appear to a little bit is fear, right? Fear of what's going to happen to that landscape that people just paid big money for you to construct for them if you don't maintain it. Who's the best one to maintain the landscape that you just constructed? You are, because you know the ins and outs of it. You installed it, and you can talk about that knowledge and, with your customers as you're trying to convert them to a maintenance customer. So this Tundra 125 is the same size as the Igloo, and you can have that for $550, almost 10 times the price of the Igloo. And their numbers, they're a public company, so their numbers tell the story. 2013 to 2016, revenue more than doubled each year. So they tapped into something that no one else had tapped into. Their gross profit margin was nearly 50%. That's almost 2x what I would expect from this type of company. I can assure you that Igloo's gross profit margin, I looked, it's not public, so I couldn't find it, but there's no way if they're selling that at $60 at walmart.com that they're making anywhere near 50% gross profit. And if you normalize their operating profit margin, that's before interest and taxes, it's going to be around 25%. Enormous operating profit margin. Think of it as net profit margin for a consumer goods company. Enormous, enormous. That's almost Apple-like, right? So that's a great story. I've used this with a couple of companies, their sales teams, to try and get their brains flowing, particularly like account managers who feel guilty about pricing things too high, who are also very fixated on cost. And so when they look at the margin, they're like, oh, I'm so embarrassed to go take this to a client. So that's where we use it. So maybe you can use it there as well. So let's shift to a landscape customer's focus. How do landscape customers define cost? The obvious one is dollars, but anyone have ideas on anything else other than dollars? If you have any thoughts, just put it in your chat box there. Time investment. Nate got it. I think Nate's my favorite. Sorry, I shouldn't say that, but Nate's got some good answers on here. He may be my favorite attendee. All right. Lisa says long-term value. The value is the other side of the cost, right? The value is what they get. We're really looking for what they pay, right? And so Nate nailed one of them, and it's time investment. There's one other component of cost. There's dollars that they pay. There's time that let's say commercial property manager, and then there's one other thing that I'm looking for. Any ideas? It's uncertainty, right? If you buy a used car, right, what are you wondering about? Is it going to need a big repair in 2 months, 3 months, a year, right? It's uncertain. You buy a new car, you have a warranty, you removed uncertainty, right? Why do people pay big dollars for extended warranties? To remove uncertainty, right? They don't like the uncertainty. So there's uncertainty if it's a new client. There's uncertainty about whether you'll perform, whether you'll do what you say you can do. So the more you can remove uncertainty, right, the lower their cost. The more that you can minimize the property manager's time, the more you lower their total cost. The more you lower the total cost in terms of time and uncertainty, the more you can raise their cost in terms of dollars, right? It's a very important principle. Probably one of the most important principles you can take away from the day. And we haven't even gotten to Excel yet. Look at that. All right, so we're gonna do kind of a dive into the trees, right? We've been looking at the forest here. Now we're gonna do a dive into the trees and get detailed on calculations, which is probably what you're expecting. Now, so there's the concept for you to think about. What do you sell? And now here comes the deep dive, right? So step one in the Herring Group path to 12% that I talked about last time is alignment, and that's making sure that your job cost actuals inform your job cost estimates, and that your job cost actuals and QuickBooks tie. In other words, when you look at your gross margin in QuickBooks and you look at your gross margin in Aspire, you want them to be the same. So labor is a big reason why some of those things get out of alignment, particularly actuals to estimates. So the question then is, how do I know if I have a problem with labor cost alignment? How do I know that my actuals and my estimated labor costs are the same? And so I'm going to show you a report you can run in Aspire. So this comes from the Aspire reports menu, pivot report work tickets, right? So pivot report work tickets report. We've got the division, we've got actual hours, we've got estimated hours, we've got the variance, we've got labor cost actual, labor cost estimate. All right, so we take the actual labor cost here, that's $2,000, divided by the actual hours, $99. Do that in a little Excel formula, right? We've got $20.46 actual, and we've got $20.88 estimated. That's good. Well, I always want the actuals to be a little bit lower than the estimates, because the estimates have to endure for a long time, right? If you're doing an estimate now, you might have to live with it, that labor rate, and all the way through 2020. All right, now let's look at enhancements. It's a different story there, right? There's $16,000 of actual cost, 911 hours of actual hours, and the actual burdened labor rate, that's what these actual dollars include, burden, right? The actual burdened labor rate is $1,759, and the estimated burden rate is $1,708. Again, the same math. So this one, we're upside down. Our actual is higher than our estimate. We need to change that estimate, and I'm going to show you how to calculate that, how to do that today. Maintenance, 1881 actual, 1644 burden, so we're upside down even more. And so we definitely need to make that change pretty quickly, since we live with these labor rates on maintenance for much longer than we'll live with them on enhancements typically. Now, in Aspire, your labor cost actual equals your this is really important. It's kind of dry, but it's really, really important. Your equals your actual hours, so whatever the guys are clocking in with, times their actual pay rate, times 1 plus the assigned labor burden. Okay, so it's basically we're including labor burden in actual, but the assumed labor burden is an estimate, right? It's not an actual. Even though it says labor cost actual, only the wage rate's actual, the labor burden is estimated, and that's one of the reasons why we have a misalignment problem on labor sometimes, or actually frequently. Okay, now let me just make one other comment on actual pay rate. Actual pay rate is really, really actual if you use IPS, right? Because the pay rates sync in your employee records in Aspire. And if someone is diligent, they're really actual if someone is diligent. If you don't use IPS, it's actual if someone is diligent about manually maintaining those pay rates in Aspire. Okay, that's a manual process. I prefer the automated process through IPS. So, but that's what actual pay rate means. Okay, and then the labor cost estimate. So those dollars up above are your estimated hours times your estimated burden labor rate, which is in the managed items section of the administrative panel. And I'll show you that icon just so you know what it looks like here in just a minute. But that's what labor estimate is. All right. So you take that labor burden rate that we were going to calculate here in a minute, and you enter that for each division. I'd like to do it by division, right? So you enter it, you calculate it for each division, and you enter it for each employee. If employees cross division, I just pick the highest, right? Doesn't really matter. I mean, you'll be close enough, right? So labor burden goes into each employee record. The burden labor rate goes into the managed items section of the administration panel, right? And you typically would have a labor rate for each division. I don't recommend having a lot of labor rates, right? Have a few, one for each division and I'm going to show you how to calculate that here in a moment as well. All right, so that's that. So let's go to what goes in burden, right? So this is a little bit theoretical, right? People have strong opinions on this. Landscape consultants have strong opinions. The Herring Group, we don't take an opinion on, we don't really have strong opinions about what should be in labor burden or what shouldn't be. We have opinions about that only based upon where things are in QuickBooks. Okay, so let me explain that. If the costs are above the gross profit line in QuickBooks, we want to see them in labor burden. Because if they're not in labor burden, then you're going to have a difference between your gross margin in QuickBooks and your gross margin in Aspire. We think the most important thing is to have those two things be the same, because it's easiest for everyone in the company to operate and know where they are if everything lines up. That's the premise behind our alignment concept. If costs are below the gross profit line in QuickBooks, we want them to be, those costs are recovered through markups and in the money bag, like we discussed last week. And then the profit target is also specified in the money bag. So that's where things go. If they're above the line in QuickBooks, you got to put them in labor burden. If they're below the line in QuickBooks, you recover those costs through markup. If you have something that's above the line in QuickBooks and you don't want it in labor burden, then just move it below the line in QuickBooks. All right, here's another Aspire report, and this is going to help you calculate your actual wage rate, which we're going to use on a spreadsheet I'm going to show you in just a moment. All right, so this is from the Aspire Reports tab, Pivot Hours, and I put all these costs in there so that you could see kind of what's available, and that helps me remember what I need to use, right? So in this case, we take base cost and we divide base cost by hours, and we get the actual wage rate. So you don't need overtime premium, you don't need you don't want the burden stuff. You're just trying to get the actual wage rate right now. And you take your base cost, divide by hours to get your actual wage rate. right? That's what was actually paid to your employees for their work. So that's how you get an Aspire. If you're not using IPS, you may want to calculate it using your payroll service reports, just to make sure that you get the actual wage rate calculated accurately. We like to check that sometime to make sure that everything's working. All right, so I'm going to go now to a spreadsheet, and this is the download that you got. Patrick will put that in your chat box here in just a minute. Patrick, you put that link in there, then go to get this spreadsheet. I'm going to move it down here. All right, so here's the spreadsheet we use. Now, we actually calculate this by division. I just kept it simple by kind of showing total company. Again, the numbers are made up. They're in the ballpark, but they're made up. So don't take these numbers and run with them. So I like to see what the average base wage rate is for the last 12 months. LTM is last 12 months. So you can go calculate that using the Aspire report or using your payroll service. And that's showing $18. I like to then run the same report for the last month or maybe 2 months. Very recent, but enough data to make sure that anomalies aren't skewing the data. And so in this case, in this example, they're $19. That's reflecting the inflation that we've seen in the industry market, in the landscape industry labor market. Then you need to forecast some inflation, right? So I put 6% in this example. Generally, we're using anywhere from 6 to 10% with companies, depending on the market. And the reason we put this inflation in, again, is because some of these proposals, particularly your maintenance proposals, maybe some of your construction proposals, you're going to have to live with those. You're trying to anticipate what those labor rates are in 2020. And then this formula just takes the max of either the last 12 months or the current and multiplies it by the inflation rate to get the new base wage rate. This is the estimated base wage rate. Now, you don't actually enter this anywhere in Aspire. You don't use this in Aspire, but you use it to calculate something that you need to input into Aspire. So that's 2014. We're talking about a 24.2% burden. I'm going to show you how to calculate that in just a moment. And then we have a new burdened rate, right, which is just the 20 times 1.242 to get you to 25.01, which is our new burden rate for estimating. Again, we like to do this by division, not total company, but I'm just illustrating kind of on a total company basis. So we compare that to what's loaded in Aspire. It's kind of a smell test, 2170, and we're thinking, okay, so we're under our estimates are currently going out $3.31 under. Does that sound reasonable? Are we missing something? Is the data skewed? Just kind of a reasonableness test. All right, so that's the burdened rate. Let me show you how to calculate burden, and then we'll pause and take questions on what goes into burden or any questions about the calculations or Aspire as it relates to payroll. Okay, so again, the only question from a Herring Group perspective, the only question that's relevant here is not here. The question that's not relevant is what should be in burden, right? Philosophically, and lots of people have philosophical arguments. We take a practical approach. So what should be in burden is what's above the line in QuickBooks. If you don't want that in burden, move it below the line. Quite simple. So now Aspire's recommended placement, Kevin talked about this last time, is to put payroll taxes above the line and everything else go below the line. And I think that's a simple way. That's kind of that middle of the road illustration that I illustrated up front on the dangers of thinking about pricing to gross margin, right? But in this case, I wanted to make it a little bit more complicated. So payroll taxes, this company has it above the line. Overtime premium above the line, workers' comp is above the line, health insurance for direct employees is below the line, there's no 401k, recruiting costs is below the line, visa costs don't have, PTO, vacation holiday sick is below the line, indirect labor. So this company has indirect labor above the line, that's like startup shutdown time. And then you go, so this number you either pull from QuickBooks or from Aspire. These other numbers you would typically pull from QuickBooks, right? And anything red is something you type in, anything black should stay. And you'll see what your historical percentages are, right? So you add up these percentages, right? And you get to 24.2%. You're dividing that by your total base wages costed to customer jobs. And that's a mouthful of words, and all those words are very important. Each one of those words is important. So it's base wages costed to customer jobs. That's really what you're looking for, as opposed to total direct labor wages, right? So that this is a smaller number than that total. And so the 484 right here is 24.2% of the 2 million. Again, the smell test current burden rates in Aspire is 14%. That's what's entered into the employee records, and we see it in the Aspire numbers, and that's a big change. And it's pretty typical that we find big changes when we work with clients, whether they're Aspire clients or anyone else's clients. We typically find that they don't have burden rate calculated well. So we go back to the summary, right? And that's our burden rate that gets entered into the employee record. This gets entered into the managed items. So if this number is wrong, then your proposals will be mispriced. If this number is wrong, then your burden rate may be wrong, and your actual labor cost in Aspire is going to be wrong, because the actual cost is the actual wages plus the assumed burden. Okay? So I'm going to pause right there, see if there are any questions.
None so far, Greg.
Okay.
Yep.
All right. Well, we'll take time. We'll have time for questions at the end, and if you have questions, just type them into the Q&A box, and we'll do our best to get to them. All right. So that's the labor rate and burden portion of pricing, right? If you recall, there's also an overhead recovery portion of pricing. That's what we just covered on our last webinar 2 weeks ago. And I wanted Kevin to talk about a second method for doing overhead recovery. So the first method was the one that we covered, where we look at expenses as a percentage of revenue, and we gave you a worksheet to make sure that the markups and the target net margins, that everything works out, okay? Kevin's going to review a second method that I'm calling it the budget dollars method. It's a very typical method for calculating cost recovery, and I'm going to turn it over to Kevin and share a spreadsheet for him.
Thanks, Greg. So as soon as we see the spreadsheet, there we go. Thank you. So I'm only going to spend a few minutes on this for two reasons. Number one, there's a thing that we all talk about, which is called standard price. Now, standard price isn't necessarily sales price, right? There is a distinction, and I think Greg made that earlier. But you need to know your standard price. And again, I don't think it's a gross margin number as much as it is as a pricing number that comes from a budget. So when you look at the screen here, starting top left, just to orient you, there's a box B25 says pipeline, right? So one of the reasons we created Aspire was so you could manage that pipeline, so that when you look at columns E, G, I, or K, and in this case, I didn't do any overhead recovery on snow. Sometimes that's a common method, which is snow will just add margin, and we'll work on market prices with that. So we're recovering really all the overhead on construction, maintenance, and enhancements. So the pipeline, how do I get to 3.8 or 799? All right, those are budgeted, targeted sales goals numbers, right? So the budget starts with the rev. I usually work bottom up from a profit number. So what you're seeing, right, from line 25, right, down to line 38 would be all that work done. So Greg's column, right, F, H, J, 15%, 23%. those were created out of the budget making process. And I won't go into that in detail, but there is some detail to coming up with that labor number 576, right? It's not just a percentage, right? It's based on looking at work in pipeline plus what's projected, plus we already do have an investment in crews and vehicles, right? So that produces for me projected GP numbers on line 34, right? So this is just done working all the math. COA, line 36, cell B, right? That is chart of accounts. So overhead, Greg talked a lot about this, is what's above, what's below the line. So when you look at the overhead budget, indirect equipment admin, $1.6 million, right? And you're thinking about what is that chart of accounts? It's the Frank Ross type chart of accounts, right? If you're using that, now you have pretty much apples to apples, so that we're defining what is above and what is below the line. And we can talk about that chart of accounts another time. But the key number is M36, right? That's the overhead that has to be recovered to generate, right? To generate those margins up top, as well as hopefully at a minimum get those sales numbers. So 9.1%, right? So let's say that's the budget. Line 41, right, is a simple calculation. 77% of all the revenues in this business, right, are coming out of construction. 16 maintenance, 2% are extra enhancements. Now, I don't have to allocate my overhead recovery that way. There's nothing that says that. This essentially talks more about, okay, market. So where can I recover my overhead without taking my labor prices and skewing them way beyond what I know I think I can recover and sell? So I did a few changes just to demonstrate that. So when you look at everything that needs to be recovered, total overhead, I said, let's just keep it pretty simple. 77% is going to be recovered by construction. 21 by maintenance, 2%, they all add up to 100, 0% overhead is being allocated over to snow. And you can do that, right? And we can talk about why you could do that at a different time. Now we get down to market. How do I take that overhead budget of $1.232 million, right? Cell E44, that 77% of the total says that's what overhead has to eat up. And so where is it going to be recovered, right? So if I split that out, 100% of the overhead has to be recovered in labor, materials, and subs. And here's where you get to play a little bit, right? In other words, I'd like to recover most of the overhead in labor and less in materials. It's not necessarily the case because market conditions will often dictate, right, what that would be. So let's just use the example and say I'm going to recover most of that overhead with labor, a minimal amount with subs, and a minimal amount of materials. And the way I usually get to these is I'm always trying to adjust those to market, right? What's realistic when someone looks at a proposal and says, there's no way I'm going to pay that for that. So looking at all of that, right? I say 87%, 10.4, column G, 95, 4.5, 0.7, right? 100% has to be allocated somewhere. Then it says, okay, looking at column E again, of the 1.2 mil, if 87% of that overhead must be recovered by labor, that means $1,065,000 has to be covered by labor, right? What I'm doing here is trying to generate a standard set of markups. So if Greg puts his cursor over 185, math is pretty simple there, right? 1065 divided by the labor budget. Greg, if you scroll up, and the labor budget in this division was 576, says that's what I have to mark up. And this would be an Aspire markup, right? A standard cost markup says labor gets marked up by 185%. Materials, 15, subs 5. Now you can see it changes very simply, Greg. If you went up to labor in E46 and said, I'm only going to recover 70% of that total overhead, and now I have to make the difference, right? So there you go. And you can see the markups change pretty substantially, right? Labor now is a 150 markup. Materials are 39% markup. And that's what I suggest when you do market analysis after you build the numbers, is that's where you can have some play and leverage. So let's leave it that way, Greg. So now I have some markups and margin. So that 15% on line 60, right now, that's going to be my net profit margin. That's my standard targeted margin. And there's Greg's number on line 62, 1950, AWR, average wage rate burden. All those calculations are critical so that that number is accurate because, as Greg said, that's your item catalog cost. That's the thing that's going to be pulled onto the template for the bid. And if I did simple math, right, that's going to produce a labor realized rate of $57 per hour. So Greg, if I went up and changed it again, 87, back to my original number, 87, I think the other was 10, you can see, right, it changes that realized rate, right, to 65 bucks an hour. So that is what I consider kind of a labor rate that might be chargeable for that particular service. That's often my checkpoint, the realized rate. How out of whack is that with the market in terms of what I can charge for a dollar value of labor per hour, right? Sales revenue divided by that labor rate. By the hours. So once I do all this, right, I have all my columns set up. I have produced on line 56 through line 60, everything Aspire needs, right? That will develop or produce standard pricing on the job, not the sales price, the standard, what I call minimum pricing, right? So it's consistent with the markups and the item catalog prices, labor being obviously critical. So if I just went in, for example, and priced the job, right now I do a check. So if I went down, Greg, to a template check, and I did the first column D, and I said, okay, I got a job that's, I estimate 100 hours with $1,000 of material and 0 subs. What should be the price on that job? And there it is, right? It says I should price that job at $29.50 with a GP, right, of 63% gross margin of that. If I did something a little bit different, you'll see if I went over to the column for maintenance and I did the same, right? 100 hours, but really no materials, very little bit, let's say 100 bucks in materials, right? I'm going to get slightly different margins, right, that are pricing based upon the markups and so on. So when Greg talked about using percentages, it's a great way to do it. Another way of doing it is to look at actually build out that budget, right? And then build out your markups based on recovery and your item catalog costs. So why are you not including equipment as a category cover overhead? I could include equipment. I was just keeping it quite simple, Judd. So yeah, if I put equipment up there, I'd have another markup for equipment, right? I'd have to have.
You're talking about equipment rental there, Kevin, that's assigned to a job, not equipment that's down in indirect expenses like
I'm talking about equipment assigned to a job, bid to a job, right?
Yeah.
Yes. Right. It's got to be, right, because if it's going to be recovered, right, I'm going to bid it to the job. So I could bid rental or I could bid my own, Greg, right? Sometimes we have equipment in the catalog as an item with a price on it, with a cost on it that I can include on the job and bid it on the job, then it would get recovered. So it's just, Judd, that I just didn't include it to keep the example quite simple. So there's another way of going about it, and sure, we can get you to Spreadsheet. Okay, thanks, Greg.
Thank you, Kevin. The master at work. It's always fun to see someone who knows this industry backwards and forwards like Kevin, and I enjoy watching him at work.
Flattery will get you everywhere, Greg, but thank you.
All right, so let's, we're going to wrap this up. I do want to get to the 6 warnings here. We have a process that we use, and the only reason I'm telling you this is that pricing isn't the only thing that you have to take care of in order to hit that 12% number. Right, there are other things. We've covered some of the things here in the seminar today and 2 weeks ago. One of the things that we didn't cover about pricing was renewal pricing. There's going to be a survey at the end if you want us to talk about renewal pricing, which is different than new proposal pricing. I think Kevin and I'd be happy to do some more webinars on these topics.
As well as benchmarking, Greg.
Yeah.
You know, if we do some future webinars on on benchmarking numbers now, we can do quite a bit with that also.
Yep. There's a contact slide here. I'm going to skip past that for just a minute and come back to it. So 6 warnings with price changes. One is you want to coordinate your burdened labor rate change, right? We showed how to calculate a burdened labor rate that goes, if you're on an Aspire, using Aspire, that goes in your service item catalog, your managed items, right? We want to coordinate that change with your markup and target margin changes, right? So especially if you have big movements, you want to make sure those changes are coordinated and that you do some tests on proposals. If you sell big jobs below the Aspire standard pricing, Kevin talked about standard pricing, right? Then your Aspire markups must be higher than what the spreadsheet indicated. Either my spreadsheet or Kevin's spreadsheet. You're gonna have, if you cut on big jobs, then you need to price these. You need to increase the standard pricing on the other jobs, because you're after an average, right? And so if you have big jobs, that's going to pull the average down, and so you need the other jobs to pull the average back up where you need it to recover all your overhead and make the profit that you want. Right, very important there. A little bit, there's a lot of math there, so I'll just give you fair warning on that, but it's very, very important. I've had some clients that have some miscellaneous charges in kits when the actual costs are not costed to a job. That creates an alignment problem, meaning that your actuals and your estimates won't be the same, right? And so that's here's why that's important. If your account manager is judged on gross profit and he's pricing things in his estimates that are not in his actuals, he can do a lousy job and still look good, right? Because his actual margin is going to be artificially high compared to the estimate, because he's got cost in the estimate bucket but doesn't have those costs in the actual bucket. I talked about this, testing your changes in the sandbox on at least 10 proposals with varying cost mixes to make sure that the proposals are coming out the way you think they are. Very, very important step there. Aspire makes it easy with the sandbox. Develop narratives for all people selling, especially if you're looking at price increases, right? Your buyer, your customer needs a story, and that's a narrative, right? And so if you're selling, we saw in Yeti has a story, right? You need a story, and you probably the owner or CEO is probably going to have to help people craft that story. Aspire makes it easy to monitor conversion rates, right? Your win-loss percentage on proposals. I always encourage people to monitor those rates after they make pricing changes, right? To make sure that they're not winning either too many proposals, which is an indication that they may be priced too low, or winning too few, which could be an indication that they're pricing too high. That's an oversimplification, but I think you get the idea. So those are the 6 warnings. I'm going to pop up the contact slide. I know that I'm easy to reach. I know Kevin's easy to reach. I know if you're not on Aspire, they'd be happy to give you a demo. We do have a survey, same survey as the last webinar. So if you completed it last time, you don't need to complete it this time. But and questions 1 and 6 are no longer relevant because they're applied to this webinar. So the rest of the questions are relevant though, and if you want to give us some feedback, we read those and we act upon those. So be delighted to have your feedback. Let me see if there are any other questions.
I think we're good, Greg, on the questions.
Okay.
We'll share the spreadsheet, and also would love feedback on future webinars like this, right, from the group. And that would include, as Greg and I talked about, deeper dives, maybe into renewals, and even some deeper dive into the stuff that I talked about here at the end, because you could see when you go into there, Greg's warning about falling in love with gross margin when your bid was borne out, right? Especially in construction and enhancements. If your labor mix and your material and submix are quite different than what you budgeted, right? Because you never really know on that world. So that benchmarking, Greg, would love to hear from you guys and let us know, and we'll happy to respond and come up with future webinars.
All right. Well, thank you very much for your attention. And again, I think you can tell from both Kevin and me that we're both very passionate about helping people get to these levels of profitability. And so we're relatively easy to reach. So feel free to reach out to us. And we hope you have a great day.
Yep. Greg, thanks for all the work and all the stuff you put on here. Fantastic.
Appreciate it, Kevin.
See you, man.